Today I'm running a quick file of an experiment I did probably 3 or 4 months ago now about the likelihood of a drop in the S&P 500 of 10% over 10 years. Rather than just use probabilities, this time I've sampled from 24 years of SPY data, and I'm bootstrapping the data for a Monte Carlo simulation of 10,000 trials, and you will see that it's still normal distribution used, which isn't completely accurate. It doesn't capture the full risk of a downturn because during times of distress, most stock data isn't actually normally distributed. It approximates a T distribution with about 3 to 4 degrees of freedom. Or if you want to get even more complex, things like Levy distributions or variations upon such more complex statistical themes. T distribution is a robust simulation and it works pretty well. Anyway, we're not using that, we're using a normal distribution, and you will see that this trial is significantly worse than my previous trial showed. That I think it was either 33 or 36% of events over 10 years probability that it's likely to drop more than 10% at some point in time. So we'll run this before I tell you what it is so you can see it for yourself. Okay, so we'll run. And we'll run we've got the SPY data there. We'll run the second chunk. And that is the function and the simulations we're running there. And here we run the trials. Replicate simulations, calculate probability, mean probability, results, etc. Oops, did it run? And you'll see that the probability is 44%. So that's a much greater likelihood of a 10% drop based on actual sample of data from, let's go up here. The data was sampled from the SPY with QuantMod get symbols from 2001 till today, which is Australia is the 17th of the 8th of 2024. It's a day behind, so in America it's Friday night late. It's the 16th of the 8th of 2024 after the market closed. A long time after the market closed. So there you go. It's an update. I've started a new Patreon account. You're welcome to donate. I'm no longer expecting you to buy me a coffee for things. I'm putting most of my work on Posit Cloud. Because I want to publish some papers, some Quarto research and things as well. And I'm also going to link it to my Patreon account, because otherwise, I don't really make money, but people do donate occasionally. Feel free to whatever, $1, $10, $2, 50 cents, whatever, I don't care. But the research will be there. I'm not sure how Patreon works, whether I can link the papers in there. I couldn't actually see a place to paste PDFs. I've got a lot of learning to do, so bear with me. It won't be the same as my buymeacoffee.com account. I won't be sharing papers and journal articles and things. The buymeacoffee.com site is no longer up and running. So those that used it in the past, sorry about that, but it's gone. So that's about it. It's a brief talk, but you can see the probability of a 10% decline is quite high, almost 50%, 44%. If you keep on running trials, it would go up a few percent, down a few percent. I've done it 3 times now, and it's roughly around the 44% mark. So it's quite high. It's much higher than just a normal distribution sample, the empirical sample. Okay, sign. Oh, one more thing. As you can see, it is quite likely, considering that using normal distributions with the sample from the real data, it's 44%. I think if you use a t-distribution or a Levy distribution or some sort of Pareto distribution or something more accurate, it would definitely be above the 50% mark. You're almost certain in a 10-year period to have a 10% decline. Since 2009, we've had one, nearly, maybe two. Since 2000 to 2009, there was 3. So yeah, up until that, there was none from 1987 till 2000, I believe. So volatility has increased in the last 2 decades since cyber trading has arrived. There's much higher volume, much higher turnover with dark pool trading. The market is just overall more risky. More people are chasing more returns with people being empowered to do their own trading. It doesn't mean they're more knowledgeable, but I'm not worried about that because I don't think most professional brokers were very knowledgeable either. They might have MBAs, but it amounts to nothing. Traditional orthodox finance is practically useless for trading. It's good for consuming investors' money. It's not good for making a profit. Anyway, signing off. At last, goodbye.